So welcome everybody to a virtual seminar presented by Dala Wealth Management at National Bank Financial featuring Franklin Templeton. My name is Sienna Foynesi and I am an associate with Dala Wealth Management. At Dala Wealth Management, we strive to inspire, create, and develop positive change by optimizing your wealth with investment and portfolio management strategies that are tax efficient and built with you in mind. Our agenda today will respect your time as we aim to keep this presentation short and to the point to maximize its value. I would like to introduce the head of Dala Wealth Management, Ramel Dalla. Ramel is a portfolio manager with 15 years of experience who combines his investment expertise with the team's in-depth financial and estate planning. Ramel will now introduce the principles of Franklin Templeton, who will then discuss opportunities, market outlook, and then answer a few questions. I'd like to now hand it over to Ramel, who will tell you more about Franklin Templeton.
Thanks, Sienna, and once again, thanks for listening in on our virtual seminar. I'd like to thank Dino for joining us today all the way from Dubai in the United Arab Emirates. Sukuk bonds managed by Franklin Templeton's manager Dino, who's with us today, presents a unique asset class in portfolio design that I've found to be uncorrelated to markets and that they possess characteristics I find provide tremendous value. So I'm looking forward to sharing this information with you, and I'm grateful for the opportunity Franklin Templeton has given us with respect to this seminar presentation. I'd like to introduce introduce our guests formally. Dino Kronfall is a Chief Investment Officer of Global Sukuk and Middle East and North Africa Fixed Income at Franklin Templeton Investments. Mr. Kronfall is responsible for the investment process, research, and performance of the Global Sukuk and MENA Fixed Income teams. He's one of the founding partners and board member of Franklin Templeton Investments Middle East, formerly of Algebra Capital, and has been with the firm since its inception in 2006. He is the lead portfolio manager of the Franklin Templeton Sahara Fund, Global Sukuk Fund, and Franklin Templeton Investment Fund, Gulf Coast Country Bond Fund, and a member of the Franklin Local Asset Management Team. He was previously the head of Shua Capital's Debt Asset Management, where he launched and managed the first fund to focus exclusively on Middle East and North African debt. Mr. Kronfall holds a bachelor's degree in business administration and an MBA from the American University of Beirut. I'd like to ask Dino to begin his presentation.
Thank you very much for that very kind introduction. And thank you all for taking the time to be with us today and to listen in on what I hope you find an interesting presentation. I wish I could be there in person, but as the events of the past year have shown, it's not always easy to do that, but I hope to be able to do that very soon. I'd also like to take advantage of the fact that we're in the early days of Ramadan to wish all of you and your families a Ramadan Mubarak. I hope it's a very pleasant and peaceful and mindful month for all of you. We have a pretty wide agenda for today. There's lots to cover. This is a topic that's very dear to me. And I know that this is not very common for many of you living in Canada. So I would like to cover as much as possible, but do understand the time constraints. So I'll try to be brief, but hopefully allow some time for Q&A a little bit later. I think as the introduction alluded to, I do represent Franklin Templeton. We are a global asset management company, over 1.5 trillion in assets, employees all over the world. And this company really is about a very interesting evolution from an asset management company in the US that has sort of branched out, covering increasing assets and geographies across the world. And it also coincides with the evolution of our fixed income group, which was an innovator or a pioneer in municipals back in the day, in mortgage-backed securities, and then more recently with quantitative science, data science, as well as, I think, catching on fairly early, the very real need for investors to really invest in a manner that's consistent with their value system. And I think it's because of this realization that we developed our global sukuk, or I should say our Sharia compliant capabilities, and we are now leaders in this space. We have one of the longest track records in the industry, but also we have a number of strategies in the socially responsible investment category, which, if we have time, we can speak about later. But I think also interesting about the organization is that it is really a collection of boutiques, and a lot of these managers, including myself, are given the resources, are given the support, but essentially the leeway to manage in a way that is most effective and most efficient for the asset class that we're covering. And so it's not unusual to find that some managers will have views that are slightly different from others. And this is in fact one of the very interesting things about our job, is that we are able to consider or incorporate the different perspectives of our colleagues, but at the end of the day, we have the independence to pursue decisions and implement our thoughts based on the markets that we're covering. Which really brings us to where we are today. Clearly, the markets have been very active, especially since the beginning of the year. We've seen a pretty serious rise in interest rates, and that has led many investors to start worrying about allocating to fixed income securities. So this, in a way, is really going to be the topic of our conversation today: global sukuk in a rising rate environment. But I think despite this rise in rates, and you can see that reflected in these real rate numbers with the orange chart here on the left, real rates are in positive territory. Nominal yields have gone up, but we continue to have a Fed that's quite dovish, that doesn't necessarily want to restrict policy, wants to remain accommodative. And I think with this increase in rates, we've shifted our position to a much more neutral stance, where we feel that the valuations are more exciting, and we think that it actually presents an interesting entry point for investors that are considering to allocate. I think it's also important to bear in mind that we continue to be in a very low rate environment. I mean, you see the Fed is still pretty much at zero. If you look at the table on the right, you see that most developed markets continue to have very low, or in many cases, negative rates. I think more than $14 trillion of debt in the developed world continues to be negative. And what this means is that you continue to find this trend of money that is going to continue to leave these more developed, established markets where yields are very low, into parts of the fixed income world where you have more yield, you have more credit risk, you have more growth. And that would include parts of the emerging markets, it would include parts of the credit markets. And this is a trend that has been ongoing for the better part of the past 10 years, and there's no real reason to feel that that's going to stop. In fact, the development of emerging markets is probably the single most important development in international finance. But it's for good reason. So it's not like investors seeking these higher returns is necessarily risk-seeking or irrational. If we look at the returns over the past 10 or even 20 years, we see that the most or the best risk-adjusted returns have really come from the external debt of emerging markets, as well as the corporate debt of the US and Europe, for that matter. This is where we've received the best risk-adjusted returns, and this is very relevant for our discussion today, because these are the two of the three principal risk factors that are involved in the sukuk market that we're going to be talking about. These are the two principal factors. There's a third one, which is obviously idiosyncratic risk tied to the issuers we're investing in, and even there we have a very interesting story that's very supportive for our outlook. But nonetheless, the growth of emerging markets we think will continue. They already represent 20% of global bond markets. They represent more than 20% of equity markets. And we have every reason to believe that this percentage will continue to increase, especially with the growth of China and other very large emerging markets. And this is relevant because it's also facilitating the growth of Islamic finance. This is today more than 2.5 trillion in assets. Other estimates put it at 3.5 or 4 trillion. The bulk of this growth has really been to the benefit of the Islamic banks, but other segments are also benefiting, from insurance companies to asset managers and obviously sukuk markets. This is important because the growth of Islamic finance is really showing that most Islamic financial institutions are able to compete and in fact capture market share against conventional counterparts. And it's also important for the Sukuk market because the largest source of demand for Sukuk continue to be these Islamic banks. So long as they're healthy, so long as they're growing, they are really able to support the development of the market and also influence some of the very defensive characteristics I'll be speaking to you about in a moment. With the growth of the Islamic finance industry, we're also going to see a corresponding growth in the Sukuk market. And the journey that this market has gone through since 2000 has been very impressive. You can see on this chart how from very humble beginnings back in 2000, less than 20 years ago now, we've seen the market balloon or grow or scale up, I should say, to over $600 billion. This is, for example, today larger than European high yield. It's larger than the Swiss bond market. And it certainly supports the argument that you can make an informed and long-term asset allocation decision to invest in the Sukuk market. It's already received some significant size, but importantly, it continues to be characterized by innovation and growth. And we continue to see more and more sectors come to the market and be represented that really allow us to build, I think, more robust, more diversified portfolios. Yes, governments and banks continue to be very important, very large issuers in the space. And this is in general quite positive because it allows policy to continue to help support the market. But today we have a very wide selection of sectors that we can invest in, everything from real estate to airlines to telecoms to oil and gas to transportation companies and so on. And this, I think, is very important to really help us navigate, what may be a more volatile future. I think also interesting to see is that the market is increasingly liquid as it's developed, as it's grown. We've seen larger issues, benchmark in size, brought to the market by the tier 1 and tier 2 global investment banks. And the general trend or the direction of liquidity has been improving. And this is almost in contrast to other fixed income sectors that have seen liquidity deteriorate a little bit because we've had most broker dealers with smaller trading books, maybe a lower risk appetite, and also I think in many parts a very interventionist central bank that has really taken out a lot of the liquidity from the market. So in a way, you have kind of two contrasting pictures. On the one hand, the Sukuk market is evolving and becoming more liquid and becoming almost as liquid as some of the other credit markets that you invest in already. And also, I would say that the market is becoming increasingly more mainstream. If we look at very popular or widely followed indices, the suite of indices from JP Morgan, for example, you find that Sukuk today represent about 4% of very popular MB emerging market bond indices, or the corporate emerging market indices, or Asian indices, and with respect to the Middle East, it's close to 20%. And this has meant that more and more investors or non-faith-based investors continue to play, I think, an increasingly important role in the market. And so all of this means that the market today is already of significant size and scale, but the outlook, I think, remains very positive. And so our estimates suggest that this market can continue to grow at 15% CAGR, which is below the 24% CAGR that it has grown at since 2000. And that would represent, and that would mean or imply that this market could be north of 2.5 or 2.7 trillion by 2030. So this is a market that continues to offer quite a bit of innovation, quite a bit of growth, and I think is increasingly a viable option, I think, for investors in the developed markets. Now, for the next bit, I want to talk a little bit about the investment characteristics. And the thing that I think is particularly relevant for you is the defensive characteristics of the market. We did touch on the fact that we are in a rising rate environment. We are talking about an environment where global financial markets are increasingly relevant. But I think the role that the Sukuk market can play in your portfolios is one that is very defensive because it can really improve your diversification, it can lower your volatility, and it can enhance returns. And I'll get to that in these next few slides. For faith-based investors or Sharia-compliant investors, I think it's almost a no-brainer. Investing in a global Sukuk fund would be a basic building block. There's no doubt that adding a fixed income component reduces your risk significantly by over 50% without compromising much of the return. But even for non-faith-based investors, there are real diversification benefits. The dial on the right here shows you that in general and over time, the Sukuk market has exhibited very low correlations to equity markets, typically below 20%, and below 50% to most fixed income sectors. These are very relevant because it really allows you to benefit from these diversifications. And I think it's also interesting because many of you, when we start talking about the countries that we invest in, would be concerned about the price of oil and how that may impact Sukuk markets. But again, here it's worth highlighting that the correlation to oil is zero. And that has been the case over the past few years, but also going back 10 years or more. And these are correlations that we don't expect to change in the immediate future. I think if you look at this chart as well, you can see that the market has delivered fairly competitive returns when you compare that to global bonds. But I think the more interesting story is how smooth that line is, or how much less volatile it has been. In fact, if you look at the Sukuk market, which invests in many emerging markets, it's interesting to see that the returns are not only competitive, but they come with less than a third of the volatility that you would expect in emerging markets. So this is the other, or the second, I think, important defensive characteristic, in that adding Sukuk to your portfolio reduces your risk. And I say this because some of the biases that I typically encounter are that, you're investing in a part of the world that is known for some conflicts, is known for, let's call it difficult geopolitical environments, also known for, obviously exporting oil, and oil prices we know are quite volatile. So the typical response is, if I add Sukuk, I'm going to be adding a lot of risk to my portfolio. But the evidence suggests it's actually the reverse, or the reality is that adding Sukuk in fact reduces portfolio risk. Not only does it reduce risk, but also during times of stress, the global Sukuk market has exhibited smaller and smaller drawdowns. And this is particularly relevant during times of market stress. And this was confirmed just as recently as the last few months. So if we look at the year-to-date numbers, the global Sukuk market is down maybe 1%, whereas emerging markets are down about 4%. If we look at last March, where markets were really under stress and emerging markets were down 19% or almost 20%, and the global Sukuk market was down about 5 or 6. So we're talking about less than 25% of the drawdown you saw in other markets. And if we look even farther back to oil prices crashing, or Brexit, or taper tantrums, there's been a number of, I think, stressful situations in financial markets. And throughout it all, the global Sukuk market has been fairly resilient. So when we are looking at quantitative measures to determine, how much to allocate to the market, and we look at standard or pretty, simple mean variance optimizations, the quantitative exercise almost always suggests that adding Sukuk typically helps you reduce portfolio risk. And depending on what your return target may also get an allocation for return maximizing portfolios. But it is always the case for risk minimizing portfolios that the global Sukuk allocation typically gets the full amount. And I think this, more than anything, explains the benefits of adding global Sukuk to a global portfolio. Now, going back to our topic today, yes, people are concerned about rising rates. And despite the fact that in my introduction, I told you we were somewhat expecting that and are shifted now to a more neutral position, I think it's worth highlighting that for those investors that continue to be worried about some more or an increase in rates, the Sukuk market comes with very high credit quality and improving fundamentals. This is going to be relevant for credit spreads going forward. The Sukuk market also comes with very modest levels of duration, and in the case of our fund, with elevated cash levels, and this is going to be very important in the management of duration risk. And finally, I think the technical backdrop, or the excess demand for the Sukuk issued is going to also be very supportive for the market going forward. So just to very briefly touch on fundamentals, I don't want to spend too much time. The story is pretty uniform across the globe. Whether we're looking at sovereigns, banks, or corporates, almost everyone has suffered in the past 12 months because of the virus. And its impact in the case of many sovereigns on oil prices. So we've seen a pretty, a consistent deterioration in credit fundamentals across the globe. I do think that today, though, we are beginning to see the world open up. We're beginning to see growth numbers accelerate. We're beginning to see inflation expectations change. We're beginning to see the vaccine rollout. And all of the, I think, high frequency indicators really point to this continuation or this opening up to continue. And so that's why I think for many sovereigns, most rating agencies now have those on a more stable outlook. In the case of many of the oil-producing countries with oil prices back up again, that's certainly very supportive for their fiscal balances. And so we feel that the environment has become more stable and is now on an improving trajectory with a lot of the bad news sort of out of the way. When we look at a lot of the corporates that we invest in, many of them are leaders in their markets, and they tend to be the larger companies that issue. And many of them, in fact, have much lower levels of debt than other emerging markets, and certainly much lower levels of debt than the advanced economies or the developed markets. And this is relevant because even though the past 12 months have been very challenging, I think their starting point was so much better that they, I think, now are in a fairly strong position with the markets beginning to reopen. So when we look at their profitability, we tend to find that they're all, fairly strong. They've got very healthy margins. The green lines that we have on the left really map to what is an investment grade credit. And you can see that the majority of the industrials or corporates in our space, would meet that. And the amount of leverage that they have also is fairly modest compared to, as I was saying, other emerging markets. And the banks as well, I think, continue to be principally characterized with very high capitalization. They're beginning to see some problems with asset quality, and we can see that now reflected in their numbers. But again, coming from a low base, they've got adequate capitalization, they've got more than enough coverage, they've got the liquidity. And so basically banks can continue not only to deal with the impact of the virus and the lockdowns that we've had, but I think importantly, they're also able to really continue to anchor or support the Sukuk market because, as I was telling you earlier, these Islamic banks are major buyers of Sukuk. And so long as they are healthy and they're in good shape, they continue to buy these Sukuk and really keep these volatility numbers quite suppressed. So the fundamentals have deteriorated, but because they were starting from a pretty good position, we don't expect any sort of liquidity or solvency issue to materialize in the near future. And then if you look at this chart here, it shows you how the benchmark for the Sukuk market has very modest levels of duration, so less than 5 years. This would compare to above 9 or 10 years for other fixed income sectors, so almost half. And you can look at our funds duration over time, and you can see how we've been actively managing that, but typically within a range of 1 to 2 years. At the moment, as of this chart, it looks like we are underweight, but as I was mentioning earlier, we have very recently moved to a more neutral position and have reduced that underweight somewhat. But still, when you think about a 5-year duration, and we think about a pretty unanimous market expectation that the Fed won't move for a couple of years, the impact of duration is going to be more muted for a Sukuk portfolio relative to other fixed income sectors. And I think this is going to be relevant. And so the best approach that we can think of to address this market is to really approach it with a global mandate, to also have an active approach to it, to really try to capitalize. So having a process that is rating agnostic, sector agnostic, and really flexible enough to really be able to go capture the opportunity wherever it is. I think it's also important to have the appropriate infrastructure. One, to be able to research the global Sukuk market, but also to be able to trade it effectively. Also to have the risk management capabilities to be able to hedge out risks in a Sharia compliant manner if you need to. And finally, to be able to have the support from a compliance and a risk system or risk framework that really gives you the confidence that we're going to be operating within set guardrails. And as an organization in general, Franklin has that. We have all of these institutional quality support services. We also have one of the largest teams that's dedicated to global Sukuk investing. And as I was mentioning earlier, these teams are a little bit unique in that they are close to the majority of Sukuk issuers. So they know these companies, they speak the language, they can add a very important qualitative dimension to the research that we produce. but at the same time, we can really benefit from the perspectives and the expertise of our colleagues that are investing in other fixed income markets. And for a global asset class, this is increasingly relevant. So to very quickly go over what our fund intends to do, it intends to canvass the entire the globe, I should say, for opportunities wherever they are. So we invest in corporate as well as sovereign sukuk, denominated mainly in US dollars, but we also look at local markets. We are building what is principally investment grade portfolio, so we can't really reduce the quality of our book below investment grade. And we've got limits to the amount of high yield, or non-dollar issuers, or illiquid issuers, or sectors, or countries as well. So we do operate with a very clearly articulated and defined risk framework to give you the confidence. And I think the results of all of this really has been, us delivering consistent performance over the years. If we go back to 2008, we've annualized above 5%. More recently, our performance has been higher. Last year, it was above 8%. If we look at the last 3 years, above 6%. And during this time, as we all know, we've had a number of, financial market issues, from commodities to geopolitics to, again, policy shakeouts. As we look forward, I'd like to just maybe highlight once more that when you're thinking about this investment, really think about it for the long term. This is, in our mind, a core asset allocation decision for Sharia compliant investors, but we think it's a very good complement for conventional investors. It's important to highlight that this market has already reached scale. It's above 600 billion, but it continues to grow and innovate. And I think it's particularly well positioned in a rising rate environment. Remember that the two dials, or the two charts around quantitative analysis, which really support the argument that adding sukuk really helps minimize portfolio risk. And finally, the best way to approach this market is to be active and to be global and to go with the right organization that has expertise. I think with that, I'd like to conclude and really open it up to any questions my hosts may have.
Thanks again, Dino. This was a great presentation. We're deeply honored to have been able to spend the time with us to explain the fund and the special characteristics that it holds. I think, importantly, the key takeaways is that the fund is not correlated to many aspects of the market, which I think is a very important consideration for portfolio design. And that you're managing many of the risks with respect to duration and the investment grade characteristics of the portfolio. So thank you once again very much for your time here. I have a couple of questions. Of course, you touched on oil prices and the volatility that they have. So please explain, if oil prices were to drop precipitously, as we've seen in the past, I mean, last year was a clear example, how does that impact the Sukuk bond fund, given that so much of the investments are based out of the Gulf Coast countries?
So that's a great question, and this is why I touched on the correlation to oil prices, but maybe just to delve a little bit deeper into it. The reason that correlation is low, and we think will continue to be low, is because many of these countries continue to have enormous financial buffers. And so when there's an oil price decline, there's typically a lag between that oil price decline, having or impacting or affecting a policy response, and then that policy response transmitting to the economy and impacting this sector or that company. Because of this lag, you tend to find that these correlation numbers remain very muted. And despite the fact that there's no doubt that lower oil prices do affect their creditworthiness negatively, in that they run bigger budget deficits, they draw down reserves, it certainly hurts them. But if they have these large buffers, it gives them some time. And so while we think that they continue to have these buffers, we think these correlation numbers are going to remain quite low. So if you think oil prices are going to go up or that they're going to go down, the way to play that would not be through the Global Sukuk Fund.
Okay, interesting. Thank you. The second question I have is, of course, you touched on this as well, the conflict in the Middle East. I mean, given the potential for sparks to fly and spontaneous events that might cause, some tragic geopolitical events there. How do you manage that risk within the fund?
So first, I would say that in general, I mean, there's been no shortage of these headlines over the past 10 years. As you all know, there's been conflicts in Iraq, in Yemen, in Syria. Now Lebanon is on the verge. I mean, there's no shortage of these issues. The Iran question continues to be an open one, and now we have a new Biden administration. So there's a number of issues that remain outstanding and will continue to be probably over the forecast period that we're discussing. But throughout these last, 5 or 10 years, these conflicts, we're not investing in these countries, and they haven't really affected the financial markets of the GCC or these Gulf countries. And so we don't think that they're going to have an impact or a correlation, to our markets. That's historically been the case, and we expect that to continue. I would also say that there's been some very positive developments recently. You've seen the normalization of ties with Israel and the UAE and Bahrain and a number of other countries. These are very significant developments, which we hope obviously lead to further normalization. Also, we've seen within the GCC a rapprochement, if you want, with Qatar, which was under embargo for a few years, and that's now been resolved. But the real way, I think, to really address that is to have a very disciplined approach to your investments. So having the right amount of position sizing, having the right risk management tools, being very humble in your approach. And that's the best, I think, defense, because no one can tell you that they know what's going to happen with these political situations. They always come up, they're always unexpected. But I think if you have a very disciplined relative value approach, if you size your bets appropriately, if you are looking at risks from different perspectives, I think, and those risks are, I think, quantified and consistent with your views. I think to a large extent, you take away the risk of something really bad happening. You may go through a short-term issue, but it typically gives you the flexibility to then react appropriately, in a measured way. And and very often it creates opportunities for us to then capture. So initially it may look bad, but then we can take advantage. And then finally, I would say many of these issues are actually global in nature. So while they may affect us, they're probably also going to be affecting other investments and other markets.
Mm-hmm. Absolutely. My last question involves something very important to us, to our process as investment portfolio managers, which is ESG and socially responsible investing. And so my question is how your fund incorporates that mindset into your methodology.
Yeah, so that's a great question. And this is where I think, Sharia compliant investment starts from a very good position, because we already begin with a number of exclusions. We don't allow conventional financial services, no tobacco, no pork, no defense, no armed. So there's already some exclusions that you're beginning with. But on top of that, I think as a firm and as an investment team, we've been incorporating ESG risk factors into our process now for a number of years. So we engage with all of our issuers on their ESG strategies, and despite the fact that this is relatively early for some of these issuers, they're all moving in the right direction. Also, I think as a firm, we have our own sovereign ESG scores. And when we look at much of the GCC and much of our Sukuk universe, we see that they are all on an unambiguously very positive trend, because they're all undergoing so much change right now. And those changes are, from a fiscal point of view, from a social point of view, from a political point of view, from an energy mix point of view, from a legal point of view, new bankruptcy regime. So there's a lot of structural reform that's taking place in our markets, and that's really helping support a lot of these ESG scores. So to answer your question, we're beginning from a good place. We're making the investments, I think, to be able to analyze and look at the data and be able to factor in those risks. But also, I think it's important to highlight that the reform momentum in the Sukuk market is a very strong one, and is definitely helping support a constructive outlook for our markets.
Very good. Well, once again, Dino, thank you so much for your time. Again, we're honored to have someone of your profile and stature speak to us today. And for everybody listening, thanks for tuning in. Naturally, if you're interested in learning more, don't hesitate to contact me directly, and we can discuss how we can incorporate this into your portfolio. Thanks, everyone, and have a great day.
Thank you very much. Bye-bye.